Saurabh Bhatia joins us, Head of Fixed Income with DSP Investment Managers. Saurabh, will markets get overly worried if the fiscal miss is there? Or even if the fiscal miss is there, that will not impress the bond market because higher fiscal ultimately will have an impact on the way how the yield curve would move?
Well, largely from what markets have been perceiving is maybe there'll be an outside chance of a minor slip in the fiscal deficit target, at best 20 basis points. But we are expecting a continuation of the numbers what we had in the interim budget, which was around 3.4. Yes, there have been shortfalls, there have been challenges, and it's a tightrope walk, considering there's not much room to expand expenditure. And the revenues do look a lot more optimistic. But the shortfall on GST, the shortfall on direct taxes, to a certain extent can be bridged by extending the subsidies into next year and partly increasing the divestment target to an extent which can offset the overall shortfall in the tax collections, and hence keep the number close to 3.4. Not to forget, government has demonstrated that it can dip more into the small savings. So these three or four items can help to bridge the shortfall in revenues and keep the numbers intact at 3.4.
Sure.
Okay. Another view, Saurabh, seems to be that if you compromise on fiscal also, the end advantage will not be there, because what will happen is that ultimately the forward market will not get excited and the cost of yield will continue to move higher. Is there merit in believing that a compromise on fisc at this point in time will not solve the problem? Optically, it may give you hope that expenditure will go high, economic recovery will not happen, but it may not happen because cost of borrowing will still remain high.
Rightly so, and that's why we believe that government may not tweak much on the numbers. We don't expect any considerable increase in the overall borrowing from the government side, and largely, if you look at from the macro pictures, not only domestic but offshore as well, yields, the global context on interest rates have been on the benign side. The growth slowdown is on the annual. Inflation has remained fairly benign. The MSP increase, what we saw yesterday, was much lower than what we saw last year. All these indicate that the interest rate regime is definitely on a softer side, and I don't think government would throw up such a higher number which can disturb the sovereign yields. And not to forget, the yields have been trading at considerable premium since over the repo rate, with this one particular context which is hanging on the fiscal side. So I think a large part of risk have already been priced in. Maybe a little bit of steepening of curve with a 10 basis point slippage in the fiscal deficit, but I don't see beyond this as a risk in this budget as such.
Saurabh, that's one part of really what we're watching out for. In terms of the kind of stimulus that we're hoping to see, or even in terms of an indication that perhaps something will roll out over the next few months in the government's term, do you feel that there are avenues that policy can explore in order to kickstart things, whether it be on the capex side, private capex, or whether it be on the consumption side?
Well, from the government side, I mean, largely we are replicating what we did in 2009 to revive growth. We had fiscal expansion to a certain extent. We had direct benefit transfers, which we have right now for the benefit to farmers. The farm loan waiver happening at almost every state level. We needed to reduce the cost of money, which has already been implemented. And the last puzzle in this to fix was liquidity. And I think after last 3 quarters or 4 quarters of very tight liquidity, we're going into a quarter which will have a surplus through the 3 months. And that should help to percolate and get the right path for getting the growth back. I don't think government from a budget context has so much room to come out with a stimulus package, which it can jeopardize the overall borrowing program and take away the effort what they have done to seed the growth.
So what is the out of jail card? If you miss fiscal, there is a problem. If you don't increase expenditure, there is a problem. Interest rates, well, they cannot go down by 100 bips given what the global inflation dynamics are and where crude is moving. So looks like we are stuck between rock and a hard surface.
One thing which helps to converge or which helps in monetary transmission is the availability of liquidity. So far, what we have addressed is cost of liquidity. As the system liquidity remains in surplus through this quarter, we should see this percolate into the short-term yields getting a little bit more softer, and once the cost of money starts percolating on a broad-based economy, it should start yielding results. Definitely for next quarter or two, we are looking at relatively slower growth, but as we head, as the macros get stable, we should be looking at the lower cost of money eventually driving demand.
Okay, fair enough. So optimistic then, Saurabh, on the way forward, or do you feel that we still got, despite whatever may come out in terms of policy, maybe a year and a half of sluggishness before we really see things turn around?
There are a few things, which not only India but the global central banks have been trying to do. And if you look at next 20 days post-budget, there are a lot of events, which are rates positive as well as, I can say, liquidity positive. We have the post-budget, we have the Liquidity Committee coming out with their recommendations, which was announced in the last MPC. Post that, we have the Capital Reserve Committee of RBI coming up with their recommendations. The Federal Reserve on 31st of July is, we're expecting a cut at the FOMC meet. The 7th July is, 7th of August, the RBI MPC again should be dovish. And over last fortnight or so, there have been a lot of new appointees in the global central banks. And if you look back, most of these appointees are on a dovish side. So from an interest rate perspective, definitely we are headed lower. Yields may adjust a little bit from a demand supply perspective, and as the liquidity remains in surplus for a considerable period of time, this is one critical impetus for growth to revive.
All right. Fair enough. Saurabh, there is one point of view that seems to suggest that, on the, with regards to expenditure, if the government is able to kind of allocate expenditure when it comes to infrastructure, when it comes to kind of, anything that's sort of capex related, that may still be taken well by the market, even if it does compromise on the fisc. However, if it's more populist in nature, that's probably not going to go down well. In terms of any kind of downside that you're anticipating, because for the most part, markets seem to be pricing in almost a non-event, or perhaps to some extent some positive commentary. Do you feel that there are any downside risks at this point?
Well, I don't see we will be going on to the next pedestal on the populism side. If you look at the past, budgets, and whenever the government comes back, on a larger picture, government has two major heads of expenditure. One is more on the infra side and different heads under it, and one is more on the farmer or the rural side. If the political mandate is very strong enough, I think the infra gets a little bit higher allocation, and that drives overall economy. If the mandate is relatively tight, the populism takes a front seat. Herein, I think a strong political mandate allows the government to move away from populism and get the macros right. We demonstrated that in the 2014 budget as such, and I think the first indication was also yesterday. The MSP hikes have been considerably lower than what we saw last year as such, and it's closer to the average of what we saw through the 14 to 16 or 14 to 2014 to 2017. So I don't see that risk of populism coming in tomorrow's budget announcements.
Thanks so much for joining us. Always a pleasure, Saurabh. Good chatting with you this morning.